We're here today with Jeff Burrow of Sierra Ocean Wealth Management, and it's a real pleasure to be able to meet with you today, be able to learn a little bit more about your business. I'd love to, I always start off by just kind of helping people get a better background of who you are as a person. So I'd love to know, how did you first get involved in financial advising, and what drew you into kind of the investment financial advising world in the first place? What were kind of those first indicators?
It's a good question. Thank you for having me with you today. And, you know, when you're kind of getting to know somebody, it's good to start at the beginning. And there was an interest in the very beginning when I was in high school, but also an unfortunate circumstance sort of kind of pushed me into learning more about it. My father died pretty young. He was 48. I was 16. And as a high school student that, was good at math and some of these other things that you might expect in a numbers business, I wasn't thinking yet that this could be a career. But, my mother comes to me and she goes, "I need your help." And of course I'm thinking, I need to maybe quit high school and work or something.
Yeah.
I got to do what I got to do for my family. She goes, "I need your help meeting with these financial planners and investment people because I don't know how to do it, And I didn't either.
Wow.
So it was a team effort of almost the blind leading the blind. But yeah, I had to sort of learn about it pretty quickly. The circumstances of this happening in the early 90s also allowed for me to assume that my investment picks were genius because it was a bull market, right? The tech market is causing everything to go up. Well, fast forward some years and I graduated out of college, went to UC Santa Barbara, graduated with honors, and I'm like, great, I got this, it's great pedigree, but no resume yet. Where am I going to go? Yeah. I wanted to get started in the business at that time in Southern California. But friends were saying you kind of need to be around where you have friends and family because if they're going to need help, they're going to trust you and know you.
Yeah.
And so they said, you got to come back to the Central Valley where you grew up. And of course, all kids that leave the Central Valley to go to school, you might know some, right?
Yes.
You go away, then you come back and you go, oh, okay, this actually is not that bad. And the advantage I had is that I was able to pass pretty difficult tests and they weren't able to find people to pass this licensing exam called the Series 7. So they gave me these aptitude tests, and they're like, "Well, we'll see what you can do, kid." And I'm like, "Okay." They're like, "You're done already?" And so I was able to get in as a 22-year-old.
Wow.
Learning how to cold call. They called me a stockbroker. These are sort of the dinosaur ages of being in the business.
Yeah.
I got started with Morgan Stanley Dean Witter, which became Morgan Stanley, and it still is Morgan Stanley today. And so I got started with a big Wall Street firm. And after that, I went independent. Company called Valley Wealth with a business partner at the time, and then I actually invented some things that were pretty interesting that allowed for me to go back to Wall Street. So I was part of. I came up with this personal financial score that had nothing to do with the credit score. And what's interesting about that is that when you say, "Are you doing well with your money?" If you brag about how good let's say your FICO score is, well, that's great. But all you've proven is that you can take debt out and pay it back. Right? You can
Have you heard Dave Ramsey?
Right.
Same thing.
Dig a hole and you can fill it back up. But really, you're not building a big mound of anything, are you?
Yeah.
And you might be in real estate, which is good. And I know you guys are in real estate, and credit scores make sense for buying things on debt. But building net worth, nobody knew how to do it from a score perspective. So it was called Flex Score. I got it patented. And we ended up selling this thing to, ultimately Goldman Sachs bought it.
Wow.
And worked for them for a few years until recently. And
what precipitated that change?
Well, when you work for Wall Street, I'll say this, it's great on the resume. Mm-hmm. You certainly get to work with very smart people, but they are a big, big company. They, as in really any Wall Street firm, that industry. And so I just wanted a little more, I think, latitude to work with a smaller set of clients with custom work. And so that's what I've done. So opened Sierra Ocean Custom Wealth to have that opportunity a couple of years ago. And that's what I've been doing.
It's interesting, just speaking a little bit about your prior firm. I do remember someone telling me it was quite eye-opening regarding Goldman Sachs, is that because they have such a reputation in the market, they do need to always be looking from a lens of that reputation management as well, which makes sense for a firm like that. But if you're in a larger firm and one of those chief lenses is reputation management versus what is the best opportunistic path to follow, I can see where that might develop friction, even though those are both very reasonable perspectives. They're just, different.
That's right. No, it's very true. Because if you're an entrepreneur, the idea is that you are running a business or coming up with business ideas and you want to execute on them. And that's kind of my soul. That's kind of where it comes from. But you're right. If there's a whole menu of investments to choose from, I would sometimes like to choose some that maybe are newer and, could be a little more progressive. They might see it as all risk.
Yeah.
But not necessarily investment risk.
Yeah.
Sometimes their reputation, they want to make sure that they only use those that they have their hands in for a longer period of time. Something wrong with that.
Yep.
And so it's good to have both choices out there. And I just wanted to be able to choose from that bucket plus maybe some more entrepreneurial buckets when it comes to investment ideas.
You spoke a little bit about kind of coming back to the Central Valley, and that is a common theme. You grow up and you leave, and at least in my case, you say, well, I'm never coming back. And then you and I both had kind of had that return back. And at least from my experience, I've found that in some senses, there's greater opportunity in a place like the Central Valley, these smaller secondary, tertiary markets, than there is in the big primary markets. I don't know if you found that to be true as well. And if so, I'd love to kind of hear, your thoughts on that.
Yeah, no, it's a great observation. And I think anybody who grows up in a small town, and I will define small as something that's not a big metropolis, maybe even a town of 100,000 people could be considered small if you're vying for the big feel. But if you grow up in a small town and you are, let's just say, ambitious, smart person that has a lot of opportunities that maybe could take them out of that town, they think that they have to go do that. And that's their prerogative. But the point is, if you go have an experience out of that town, learn about business, right? Become part of a network of a larger group of people, all you have to do is go back to where you were to have a big advantage. Yeah. Right?
Absolutely.
Big fish, small pond.
Yeah.
And so the name of my company, people ask about. They're like, Sea or Ocean, where does that come from? I could give you a very long story, or I could just tell you that almost all of my clients are between the Sierra Nevada mountain range and the Pacific Ocean.
Yeah. Yeah.
And it's because when people from, let's say, the Bay Area or the Southern California area come into the Central Valley to help in a business realm, they're often, I think, underestimating the amount of wealth that's here, right? The amount of business prowess that is here. And so they go back home and just deal with those people. Well, I live here and I work here, as do you. So it's a huge advantage to work with these people that need help from well-networked, smart people, frankly, like you, and maybe like me. And so, that is an advantage.
Yeah, and it's interesting because also in that kind of small town psychology, you feel there's a little bit of we're not as sophisticated, or we're not, there's some internal psychology too, not always, external. And we've certainly found that there's a lot more, as you said, there's a lot more sophistication in that market than we give credit for, and a lot more opportunity.
Certainly. For sure. Yeah.
I'd love to, you spoke a little bit about your father passing away when you were at a young age. I can only imagine everything associated with that. From a business standpoint, I'd love to know kind of what were times or a particular time that was particularly challenging. And as we all know, we don't end up talking about the good times. We always end up talking about the bad times because those are the formative aspects of our, life story. I'd love to understand, maybe what was one or two, more challenging times in your business.
Yeah. The business itself of working in the investment markets, which does include real estate, it includes stocks, it includes bonds, it includes commodities, it includes things that people don't even think necessarily like gold, right? Yeah. There's basically, if you have something that could be sold for a different price tomorrow than you bought it for today, that's the investment market. And when somebody says, well, that must be stressful, yes, it is. And so it is stressful for the reasons people would understand and expect, but there's other reasons too, and that's that, your clients become close to you. They're like family. And so I think the times that have been rough in this business are when both, let's say the stock market or the real estate market is having a tough time. 2007, 8, and 9. This time that I think people will recall.
Maybe right now.
Yeah, we could be going into one right now. And they're tough for those reasons, but it's because when somebody trusts you to do the right thing with their money, and I'm a fiduciary, and by law, that is what I do. I treat other people's money as if it were my own.
Yeah.
I take this very seriously. And so a phone call of, I'm really worried, can you help me through this? I get it. I feel it. I mean, I'm invested in the same thing. My portfolio is also down.
Yeah.
There's no magical solution that allows me to make money all the time.
Yeah.
That doesn't work that way. So it is tough during those markets to kind of get through it. I will say in 2008 and 9, my former business partner, Mr. Jason Gordo, and I, we opened this company called Valley Wealth. And we did well for the first 6 months. And then 2008 just absolutely craters us. And I'll never forget, we looked in our bank account and we kind of went, wow, we don't have enough to make payroll if we don't find another client in the next week. And it's one of these like, that's a little bit sobering. And so I was at home that weekend, and I thought to myself, we have to come up with something. I mean, we've got to go big or go home, basically. This is the classic situation.
Yeah.
And so we came up with this concept of having a large economic conference that had less to do with what to invest in and more to do with how can we get through this with our feelings, right? How can we motivate people to know that just like all times, we'll get through this.
Yeah.
So we came up with, it was called This Economy and You. It was on at the big, Gallo Center for the Arts in Modesto. And, we had some great entrepreneurs, Mike Segaris, Dan Costa, these are people that were able to say, because they had business experience that was big and long, and they said, we're going to get through this. It's going to be fine. And we kind of knew that, but to hear these people say, we've been here, we're going to be okay.
Yeah.
We get 1,000 people that kind of really made a difference in their lives. So it was fun to kind of sort of hit rock bottom, if you will, and realize that this could be it. Yeah. And then realize that, no, you just keep going. Yeah. You just keep walking. Don't stop,
Well, and that it really is kind of that next level thinking of an entrepreneur, because you just said two things very closely to each other, which was we didn't have enough to make payroll, or obviously you solved that between then and payroll. And then you said, and therefore we put on a giant event at the Gallo Center. Most people would have said these two are clearly opposites. You don't go and do that when you're feeling that, and yet it is that kind of next level thinking of like, it's my business partner Joe has often used the terminology from I think it was Cortez, that when he landed in Mexico they burned the boats, and that was the physical statement to his crew. We're all in. We're not going back. We're not going back. And that's where the phrase, we burned the boats. That's where the phrase came from.
I love that.
And that is kind of a moment like that where, you're essentially saying, no, we are all in. And you can't, with entrepreneurship, you can't step timidly into it. You really do have to have that kind of all in.
That's it.
So it worked.
It worked. Here I am. Here we are. And it's funny, you're right, because you talk about that big event. I'm sitting down across, from Jason, and we're kind of looking at it, and both of us were very entrepreneurial. And not for 1 second did either one of us doubt that it would work. But what an insane proposition.
Yeah.
Looking back on it, it's just kind of like, what are you doing? But this is why entrepreneurism has risks. It doesn't always work. Yeah. That one did.
Yeah.
And I think if we doubted ourselves for a second, it may not have.
Yeah.
But we just knew it was going to work no matter what, right?
We got it.
You just got to keep going.
There's some delusion. There's always some delusion involved in the entrepreneurial journey.
It would be the first time people call us crazy.
Unbridled optimism.
That's right. That's right.
So earlier you mentioned the word fiduciary.
Yeah.
And I think for a lot of people, they may not understand how the wealth management world works and how that industry works. And I'd love you to kind of, if you don't mind, just kind of speak a little bit about, what that fiduciary role is from a legal standpoint and how it differs from, firms that have that and firms that don't have that.
Sure. Yeah, that question is something that I'm glad you asked, because I think it's glossed over too much. Mm-hmm. In the world of hiring, an attorney or an accountant, there's people that you would assume are going to, look after your best interests.
Yep.
You would also assume the same thing about somebody handling your money and giving you investment advice. But the industry is set up where you have, actually the majority of people in this industry are not licensed and set up to be fiduciaries. They are essentially, they're officially called registered representatives, and they have a license, but they're actually representing the best interest of the company they work for. Right? So a great example would be the bank.
Yeah.
There's nothing wrong with banks.
Yeah.
But the bank, people that can give you investments, they are selling, of course, a CD from the bank or a product that's affiliated with the bank. And their income, they are employees of that bank. So their income is derived from representing the interests of their employer, as many employees are. Well, as a fiduciary, you have to represent the best interests of your boss, who's actually the client. The client relationship with you is one in which you have that responsibility to them. And I could look at 14 different investments, and they might all look like good opportunities, but I have to view it as if it were my own money. So it's my own money. I'm going to put them in the one that probably has the least internal expenses on it, right? And then the way that we are compensated, I think, also shows the difference where a registered representative that is not a fiduciary is going to get paid a commission, right? Or something built in. And it may not be hidden, but it's still hard to figure out. When you're working with a fiduciary, it's an open relationship, kind of like an hourly rate or a project fee, or it's a percentage of assets under management. And what you end up having there is a known cost. And if it's a percentage of assets under management, if your portfolio value goes up, guess what? So does my fee. But if your portfolio value goes down, guess what? So do my fees. So you can see the vested interest in working with a fiduciary in that respect versus just somebody who gets paid at the beginning and then sort of forgets about it from there on.
Fascinating. And is that kind of the difference between the term RIA and like what they call wirehouses or whatever? So I'm just curious that, if I were looking for someone who has the legal fiduciary arrangement, is that what I would look for essentially as a firm that is a registered
investment advisor?
Got it.
And the only way to know for sure is simply ask the person you're working with. The question is very simple. Are you working with me in a fiduciary relationship? It's a yes or a no. If it's a yes, you're good. If it's a no, you need to find out how you can become a fiduciary relationship. And I'm not saying that they're all bad, but if that's what you want, you need to know.
If you want that alignment.
Exactly.
All right, so this is just kind of a fun question, but we're in a interesting time in the market. Maybe we're always in interesting times, but this one's particularly interesting. If you had $1 million right now, outside of your normal portfolio construction, this is just money to go out and put into one thing or one strategy or whatever. What is interesting to you right now?
You're asking me for investment advice? Talking about fiduciary relationship.
No. I'm asking what you would do.
Exactly. So the question's great, and I think we have to first ask these questions and know what's my time frame, right? Because honestly, if I did come into $1 million and I'm 25 years old, let's say, and I have a goal of I want to buy a home, then I probably shouldn't take that $1 million and invest it in something that over a short period of time could turn into much less than $1 million. But if I said, this is for the future investment and I've got 10 plus years, the next question you would ask yourself is, do I want this to be liquid? Is this something that if I needed to change my mind and sort of dip into, can I just simply call Jeff and ask for it? Or if you're doing it yourself, just push the button and get the money back? If you need it to be liquid, it's pretty simple. You're wanting to invest in a broad basket of stocks. A lot of people hear about the S&P 500. But if you've got 10 or more years, just sort of riding that wave, you're going to get what most people would deem to be an average rate of return. That's good. An average rate of return for the stock market oftentimes is high single digits, maybe even 10%. On average. That doesn't mean every year. In fact, most years you don't make anything near that. In the stock market, you're going to be making 15+% in some years and losing, 10 or more percent in other years. But on average, you might make 8 to 10. If you were looking to be illiquid, I would probably put half of it into the stock market and half of it into real estate. And for me, people are wondering why I would recommend real estate. They're like, well, you don't do real estate. I do. I put portfolios together, right? And so, in fact, we invest together. You're on the real estate side. But for me, real estate is a great investment, but a lot of people forget about the liquidity portion of it. So once you've managed, how much you need liquid, I think real estate's a great way to invest. And I'll just add this. Let's say you're in the short term, not sure what you want to do. U.S. Treasuries are going to be, with today's interest rates, here we are in October of 2023, so let's disclaim the time frame. But in today's interest rate environment, you can actually make, between 4 and 5%.
Which is mind-boggling.
What would be called risk-free if you're in the U.S. Treasuries, right? That's not bad. That's not bad at all. So some good choices there, and it really depends on, your appetite for risk. And, look, if you have more of an appetite for risk and we're talking individually, there's all kinds of independent investment strategies that I actually use for myself that I might recommend for you.
Yeah.
We can't talk about it publicly because you've got to put the prospectus and all the offering information in front of them. But if you are, interested in those things, I think $1 million opportunity to invest today is really is a great one. It's always good as long as you have a good time horizon.
Yeah. Interesting. I didn't expect the advertisement on real estate, but while we're on that topic, obviously you guys have some investments with us. When you look at a real estate private equity firm or a strategy, I'm just curious, what are things that you find interesting, and what are things that you look for in a strategy like that?
So for me, it always comes down to the people and the process. Mm-hmm. If you have people that you could see as business partners, working with them, almost like family members, right? These are people that you want to do business with. And, I've always found that when you're evaluating a company, if they've got more salespeople than they do analysts, that's an interesting ratio. Why is it that you're more focused on finding other people's money to invest than you are focused on finding smart people to analyze the investments you're going to put that money in? Yeah. And I think, being smart is really hard to define because somebody could be extremely great at passing tests. I have young interns at colleges that come in to do job shadowing and internships, and they want to show me how smart they are. And they're like, look, I'm getting all A's. Yeah. I go, that's great, but you may want to work on your social skills. You may want to work on your emotional intelligence. Yeah. You may want to work on these things that don't show up on a resume or pedigree. Yeah. And it's that type of information that I look for in people when I'm looking to invest in their company and in their investments. As far as the process, I will say that some people, as I said earlier in our interview here, mistake luck for genius. Okay. And in the real estate markets, with the real estate or with interest rates going down in our most recent past history, it caused for a lot of the real estate markets to be a little easier to navigate. Yeah. Right. Absolutely. So it really makes sense to make sure you've got people that have the experience in tough markets, both geographically tough markets, but also economically tough markets. So it's important to kind of vet those things. If it's just track record, you're overlooking a lot. Yep. Right. So the people and the process of how they sort of go through to make good investment decisions is super important.
You touched on something about the real estate cycles, and we see all sorts of both real estate, financial market, economic cycles. I'm curious, through your lens, you started investing, in the early mid 90s through family circumstance. What would you say from a market cycle perspective you've learned most from, kind of living through those cycles, which again, a lot of younger people don't have the benefit of until it happens again. Yeah.
And by younger people, you're saying I'm old, Ryan. I appreciate it. What you're saying is experience.
Wisdom. That was the word I was looking for. Yes. Wisdom.
But it is true though, and you only get what I tell my kids, and this is a great segue to life advice. So forget investment advice. Yeah. The only way to make good decisions is to first make bad decisions. And so I can tell you about some of those. Yeah. And what I can tell you is that if you're thinking that what you're about to invest in is going to be a slam dunk, you should definitely take a seat and evaluate it a second time. Because if it's obvious to you, I can tell you that it's obvious to a way larger audience than just you. And if everybody else has figured it out, there's a decent chance you're about to invest in something that is about to be at its highest level ever. Like buying high is the other way to look at it. Yeah. So we've heard of contrarian investors, the value investors, the Benjamin Grahams, the Warren Buffetts. It's not that they are, believe me, they're very smart. I'm not going to say they're not smart. It's not that they're smarter than you. They probably are. But here's what they're doing. They are investing during times that do not feel good to invest. Yeah. Okay? Yeah. When in 2008, 9, and 10, and you guys are taking money to go put into real estate, and everybody else is looking to sell. Yeah. What? You're going to buy? That's crazy. Yeah. That's what you want to hear. Yeah. That means you're onto something, right? What? You're going to go rent the Gallo Center for the Arts and do an economic event during the stock market collapsing when you have barely no money? Yes, we are. Yes, we are. Yeah. It's those kinds of moves in the investment market that allow for you to make money.
Yeah.
But this is the caveat.
Yeah.
You not only have to have very strong nerves to kind of go through it,
yeah.
you have to have patience. Yeah. Because it takes time for those to play out, right?
Yeah.
And so, again, if it's easy, it's not going to be nearly as easy as you think. You got to kind of stick with it through the end. So I would just say during any tough market environment, what I've learned is that if what you're doing seems like the obvious move, evaluate it again because you may be going in the wrong direction.
Yeah, absolutely. I'll just close out with a kind of a crystal ball that we're looking for, which is we're in a very interesting environment, as we've already talked about, with inflation, with interest rates, with the current stock market, with the real estate market. How do you see this playing out over the next, let's say, 24 months? And again, this is crystal ball, so we know that this is purely prognostication.
Yeah. I think it's totally prognostication. My crystal ball broke in 2008. But here's what I do know. There are so many moving parts to our economy currently, and there always is.
Yeah.
But there's so many things that are hard to predict in the short term that it would make it difficult to say steadily up or steadily down.
Yeah.
And because of that, I would assume that in 24 months, we very well might be exactly in the same place we are today. And that does not mean that we're going to have a sideways move. What I mean by that is it could be very rapidly up and then right back down.
Yeah.
It could be the opposite. It could be very rapidly down and then right back up. But because of the volatility, we've got to remember that there are not a bunch of rational human beings making decisions in the investment markets.
Yeah.
We know it's tens of millions of irrational people, and I'm including myself in that bit. Right? As humans, we're irrational.
Yeah.
And our primate brains, our caveman history is sort of driving us to sometimes make decisions.
Absolutely.
So we have to let the long term play out. But 24 months is short enough to make me think that we've got interest rates that have to be figured out, inflation that has to be figured out. We have a war right now, both in the Middle East and in Eastern Europe. Wars.
Yeah.
Lots of things. And so because of all of that, I would say that for the most part, people probably should not take their money and just assume that it's going to go up.
Yep.
They should assume that whatever's going to happen, it's going to be volatile and just to stay the course. So I'm going to hedge my bet on that and not tell you it's up or down. I do really think that even past 24 months, maybe even for the next 5 years, it could be very much sideways.
Yeah, kind of this. Yep.
Yep. A lot of news to get through.
Fascinating. Well, thank you for taking the time today. Really enjoyed our conversation. And again, this is Jeff Burrow with Sierra Ocean Custom Wealth, and it's been a privilege to talk with you.
Thank you. Appreciate it.
Thank you for listening to Durable Value, an investors podcast, where we demystify commercial real estate with safe, sound investment strategies to help you balance your portfolio. If you enjoyed this podcast, be sure to rate it on iTunes or wherever you get your podcasts. To learn more, visit GresetaPartners.com, where you'll find more information, investors tools, case studies, and more. This podcast is hosted by Joe Muratori and Ryan Swehla. It's produced, edited, and mixed by Melodic, with intro music by Ian Post. Thanks again for listening, and we'll see you next time.